Hey, ladies and gentlemen, I want to have a much more serious topic today surrounding that conversation of, do we buy ETFs for a safe long-term retirement plan, or do we buy individual stocks and try and outperform the market? We've been getting fed a whole lot of lies about past performance equaling future returns, and I look so forward to breaking this down for you. So, ladies and gentlemen, let's jump right into this.
Drop it.
Welcome back. My passive income investors, like you, have been fed a whole lot of bullshit from Wall Street surrounding the index and ETF market. In this video, I'm going to break down some fallacies you keep telling yourself that just aren't true, and then I'm going to break down a strategy that will allow you to outperform these basic indexes that I have used that has worked successfully time and time again. But to slap you straight, I'm sure you've heard the term, guys, that past performance doesn't represent future returns. And in the Western world, we keep feeding ourselves this lie that if we want a decent retirement, well, we put our money into the economy, the US economy, or something like an S&P 500 index, which we're taking a look at right here, which gives you an average market return of 8% after inflation. But this doesn't always hold true. And a lot of investors think this is their safe haven to retirement. But if you took that BS statement and looked beyond the US borders and went and told anybody else anywhere in the world and said, look, just invest into your overall economy and you'll have a great retirement. But if we were to take that statement over to China and take a look at the last 20-year rate of return, it has only been roughly 30%. Heck, we could go over to the Tokyo Stock Exchange, where we could see over the last 30 years, you would have actually had a negative return of 20%. Again, with the Euro stocks, guys, going over to Europe, same sort of deal. The markets have been completely flat, and Canada is by no means an exception to this, guys, where the stock market hasn't done anything over the last 10 or 15 years. And Warren Buffett has famously said that index funds are a tool against ignorance.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it'd amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776.
But sometimes that tool can't fix your ignorance, and we have to keep in mind that this might not always be the case in the future, that we're going to continue to get those market average returns. And don't get me wrong, I got nothing against index funds here, ladies and gentlemen. There's just facts behind them that I think if you just expanded your knowledge and just did a little bit more homework, you'd easily be able to outperform the market and get yourself to a quicker retirement, which I want to share with you in this video. And I'm not saying you have to deep dive heavily into all of these companies and things like that, but what you can do is take your favorite ETF, okay, something like the Vanguard S&P 500 that we were just looking at, and go into their holdings or their components, because most people don't want to do the homework to actually figure out what the best companies are, how to diversify their portfolio. But Vanguard and most indexes have actually already done the homework for you. And this follows into this other lie we keep telling ourselves, is that when we buy an index fund, well, we're getting equal diversification across the entire market, but that's not true either. Taking the Vanguard index as an example here, guys, 25% of the entire holdings are only made up of these top 10 companies. And in fact, Microsoft and Apple already make up more than 10% of the entire index. So letting that knowledge sink in, that at some point in the future, we might not get market average returns from an S&P 500 index, and knowing that these indexes don't actually equally weight out their fund and you're not getting fair diversification, I think it's an important step to take. Even if you don't do your own homework, take the homework these index funds have done and start buying these individual stocks that just consistently outperform. Again, guys, Microsoft and Apple make up more than 10% of this total weighted index. And if you bought Apple over the last 5 years, that would have been the only stock you needed to buy to outperform. But you could have made your own little ETF of just these top 5 companies. Guys, you could have exploded into your future retirement a lot faster than you could have ever thought, and you wouldn't have had to pay Vanguard a management fee. Mind you, Vanguard has the lowest management fees, but I want to share with you a deeper in-depth understanding of this strategy, not just looking at the top weighted indexes, guys. So let's take something like Vanguard, the VNQ, which is basically a real estate investment trust index. And if we go into this, we can take a look and see their management fee still fairly low, a 5.21% dividend yield, which makes a lot of people not want to do any homework past that, and they say this looks good. But if we take a look at the 5-year performance, it has been completely stagnant. But if we go into those individual holdings and components again, guys, and if we go in here, we can see Vanguard's top rated real estate investment trust is another index that they hold, which I found very unusual, because I wonder if you're paying another management fee for them to be holding their own ETF. I don't really understand that. But let's take a look at their top 5 holdings and see if you took the knowledge of this index and said, look, I'm going to make my own ETF of what they think the top 5 companies are. And we can see American Towers makes up 7.4% of this ETF. We got Prologis, Crown Castle International, Equinox, and then we got Simon Properties. So let's take a look at each one of these and see how they would have performed against this index that has been trading completely flat. So let's take a look. So here we have American Towers, that if you held on to this over the last 5 years, you're up 161%. Prologis, up 118%. We got Crown Castle up another 93%. And here we go. We got Equinix up another 155%. And then, oh my goodness, of those top 5, we finally have one that is negatively performing, and it is down something like 72.5%. I think it's quite safe to say that with this example of under diversifying, picking the top performing REITs, that you would have still, even with this one stock underperforming, have been severely outperforming that basic index. Would have paid no management fees, and those dividends would have been 100% yours. Now let's take this strategy one step farther and look at another ETF. So here is a financially weighted ETF, guys, with a management fee. If we added up 0.10 plus 0.02 there, you're paying out about 0.12%. It has a dividend yield of 3.86%, and the 5-year performance, again, has almost been completely stagnant. But again, let's go into the components, guys. We can see JP Morgan makes up 10%. We got Berkshire Hathaway in here, Bank of America. We got Wells Fargo, Citigroup making up those top 5 companies. So let's take a look individually how they're performing. Well, even in this downturn crash of a market we're in, we got JP Morgan here up 42%. We got Berkshire Hathaway up 30%. We got Bank of America up 30%. We got Wells Fargo down 50%, and then we have Citigroup down 20%. If you were to take all of these numbers and actually add them up, you would still be up 20 to 30% over the basic index. Now, I have taken this example and I have used it in my own personal portfolio, and what I have done is I have personally made more than 40% of my entire portfolio, some of these top weighted companies, and they consistently continue to outperform even in this downturn market. The companies that I hold, you might already know. We're talking about Microsoft, Apple, Facebook, Johnson & Johnson. I wouldn't mind even adding Visa at these levels. So letting all of this sink in, what have we learned so far? Well, look, index funds don't always outperform the market, and the fact that we keep feeding ourselves this lie from Wall Street that if we want that 8% market average return, we're going to have to buy an S&P 500 index. Well, that might not hold true in the future. The second thing we've learned here, guys, is that these ETFs that we think are fully diversifying us amongst all these companies is just not true. They weight themselves with the largest, best performing companies by about 20 to 25%. So why hold the basket of terrible stocks and good stocks and get that market average return when we can consistently outperform the market by just buying those top rated companies? And this is a strategy that holds true amongst almost every ETF out there, any top performing ETF that is. And I want you guys to share with me some ETFs in the description below, and I want you to do your own personal homework, and I want you to go through them and find those top 5 companies and tell me if you just held those top 5 companies, would you have outperformed that basic ETF that you might have even considered yourself buying into? And then finally, the best thing about all of this, ladies and gentlemen, is that if the markets continually get worse and things don't get better, these top weighted companies are top weighted for a reason, and usually it's because they're staples to society and they're going to be around forever. So if we can't get an equity return out of the markets, which is what you're pretty much relying on when you're buying a Vanguard or S&P 500 index, now you're going to be getting the bonus of the dividends, ladies and gentlemen, which historically grow over time. And if these are staples to society and society runs flat, you're still going to be getting a consistent paycheck as a dividend investor, which is why I think dividend investing is one of the most successful strategies out in the world today. It is one that I personally overutilize. Right now, I only hold 2 stocks that don't pay dividends for growth, which I have been lucky to experience experience in these companies, talking about Tesla and Facebook here, I will always be flooding a huge percent of my money and my assets into dividend-paying stocks. I like keeping my risk very low because I'm sure you've heard that saying as well, guys, that if a stock doesn't pay a dividend, you're technically gambling and speculating that in the future something's going to get a lot better or somebody's going to be willing to pay you more for that stock than you paid for it. So I recommend you mitigate that risk as much as possible, as that dividend gives you that stability and comfort in your life, knowing for those worst case scenarios. Now, I would love to know what you guys think. I'm hoping I didn't offend you if you are really big into the ETF market. These are just some facts I don't think get clarified enough. So consider slapping a like if you learned something today, but stay cool, stay awesome, and I look forward to chatting to you tomorrow.